The real question here is what drives spending, and most people assume that spending is determined by one thing, money. But that's not technically true. So if we lived in a money-based society, then the way it would work is you make $40,000 a year, for example, and all you can spend is $40,000 a year. So if you make 40 grand, that's the maximum you can spend. And if you don't have any more money to spend, then you can't spend any more money. But that's not how our system works. We live in a credit-based system. That means you can spend, I spelled that wrong, credit. You can spend money or you can spend debt. Now things are a little bit different because maybe you make $40,000 worth of money from your job, but you also have the ability to spend $20,000 worth of credit thanks to the help of banks and this credit-based system. So this credit-based system allows more spending to happen because now you don't just have to spend money based off of how much money you have or based off of how much money you earn. You can spend money based off of how much credit you can qualify for. The more credit you qualify for, the more spending that can happen, and the more spending that happens, the more the economy can grow and the faster the economy can grow. Now again, I'm not saying this is right or wrong, this is how the system works. Now if we expand this one step further, this is what makes up, I'll put this in red, the economy. Because the economy is now a sum of all the transactions that happen within this economic system. So it's a sum of all the spending that happens in the system. And this economy functions on three different things, three different types of spending. You can buy goods, you can buy services, or you can buy assets, financial assets, things like real estate as an investment, things like stocks, things like companies, things like bonds. So when you sum all these things, three things up, that's what the economy is, and it's made up of money and credit, and it's determined through spending. Now, while this part might be relatively simple to understand, it gets a little bit more complex because this makes up the economy. But we have this external factor a little bit outside of the economy, which influences the economy itself too. And that has to do with the government and the central bank, the Federal Reserve Bank. So if we look at this big picture, we have an economy which is the sum of all transactions that happen. And this could be people buying goods and people buying services and people buying financial assets. And this is done through spending, but people spending money. I give you something in exchange for something else. And this is done through money and credit. It's not just the money that we earn, but we have this credit-based system where the more I earn, the more credit I qualify for, meaning the more money that I can spend. And this money and credit system is then influenced by the government and the Fed. Let me start by talking about the government here. Our government is not a for-profit entity. You can compare it to something like Chipotle because Chipotle creates Chipotle bowls. They sell you guac, and in exchange for them doing that, you pay them money. So they sell a good in exchange for money. The government doesn't do that. They are not a for-profit entity like Chipotle is. Instead, the government gets their money from tax dollars. So then they generate this tax dollars because people like you and me, we go to work, we make money, we pay taxes. And then after the government gets these tax dollars, they can spend this money. But the issue that the United States particularly has been facing is that the government has been spending more money than it brings in. In a purely money-based system, what you would want is you would want your income to be greater than or equal to your expenses. I mean, think about anything else. If you make $40,000 a year, you don't want to spend more than 40 grand a year because then otherwise you're in the hole. So it works the same with the government. But that's not what happens. Right now we have this massive amount of national debt. We have this national deficit. We have the growing debt bubble that people talk about. And so all these things mean is that the government has more expenses than income. So they bring in their tax dollars right here, and it is not enough to cover these expenses. And so if the government is spending more money than they bring in, what do? Well, they have to go and borrow this money. Remember, credit-based system. And where does the government go to borrow money? Because when you want to borrow money to buy a home, you just go to the bank. Well, it's a little bit different for the government. What the government does is first they will go to different countries. They can go to places like China and Japan, and they can say, lend us some money. And if they can't get enough money there, then they might go to private citizens, people like you and me, and they can say, hey, do you want to loan money to your government? This is called a treasury bond. A treasury bond is when you loan money to the government. And if they can't get enough money from regular people, then they call up somebody else. They call up the Federal Reserve Bank. And this is where things get even more interesting because it's called the Federal Reserve Bank. However, they're not federal. It says so on their website. They don't keep any cash reserves anywhere, and they're not a bank. you and I can't go there to bank. So they have this name, the Federal Reserve Bank, even though they're not federal, they're not a reserve, and they are not a bank. However, they are the central bank, and what they have the ability to do is they have the ability to control this. They are in charge of monitoring and controlling the money supply. I'm getting a little bit ahead of myself right now, so let me take one quick step back. So the government now needs to spend more money, or they have more expenses than they have income. So what do? Well, they'll issue these treasury bonds, and then they'll call up the Federal Reserve Bank and they'll say, hey Fed, we just issued $1 trillion worth of treasury bonds and we need somebody to buy them. We need this $1 trillion, so the government needs a loan. So what happens? That's when the Fed will then print $1 trillion essentially out of thin air, because remember, they don't have cash reserves anywhere. They have the ability to control the monetary supply, so they can print this money out of thin air. They give it to the government, and now the government has just gotten $1 trillion. They issued $1 trillion bond, meaning they put out a request to borrow $1 trillion, and they couldn't get this money from somewhere else, so the Fed prints this money, they give it to the government, and now the government has $1 trillion that they can use to fund their government operations, to fund whatever systems that they want to help their citizens, or supposedly and hopefully help their citizens. Debt gives you the ability to spend your future income today. If you want to go out and buy a $1,000 watch, you can take your money that you've already earned to go out and buy this watch, or you can use credit to buy this $1,000 watch, even though you don't have the money. That lets you boost spending, which grows the economy. However, now you have to pay this money back with your future income. So now your future money that you earn is going to have to go back to pay back this watch plus interest. So when you go out and you borrow debt, what you're doing is you're spending your future income today. And when a lot of debt and credit is being used to buy unproductive assets, it's people just spending money on things that they don't need, that doesn't produce any income. Now what you're doing is you're living in this consumer debt culture. You're buying a whole bunch of Gucci and Louis Vuitton and nice vacations, which make you feel richer. It makes you feel this more luxurious life, but then you have to pay this money back plus interest. So now more of your future income, more of your future spending is being used not to buy more stuff, but to just pay back your previous purchases. So this is what starts to create these cycles, because in the short term, you can create this boom. More credit allows you to spend more money, which allows you to grow the economy. But then when people spend too much money because we've taken on too much debt as a society, then people have to consolidate. You start spending less money on things because now more of your money is being used to pay down this debt. So less money is being spent on other things, which means the economy slows down. This is what starts to create these cycles. These booms and busts have happened in our society pretty much every decade, or about every decade for the last century. And it's happened not just in the United States, but in previous civilizations going all the way back to the Roman Empire. This is where you have to understand what the government and the Federal Reserve Bank do, because anytime you see this type of economic slowdown, what you see happen is people's money goes down, because now people are not working. You see a recession and people's wages go down because either you lose your income or companies can't afford to pay you as much. So now money goes down. I'm gonna draw you a little arrow over there. Well, when money goes down, what happens? Not only does spending go down because you have less money, but credit also goes down, because if you have less income, or if you don't have a job, now you're going to go to the bank and they're going to say, we're not willing to lend you as much money as before. Before, if you made 40 grand, maybe you could borrow $20,000. But if you don't have a job, the bank is not going to be willing to lend you anything. So not only does the money supply go down, but the credit supply goes down. This affects spending now even more significantly, because not only do people spend less here, but they're also spending less here. So now you start to create this negative economic spiral, because this goes down, which affects the spending, which affects the economy, which means that now more businesses are going to have less money to invest in their employees. Less businesses are going to have money to invest in more stores. They're going to have less money to invest in better guacamole. So now you start to create this negative economic spiral. So then companies start downsizing, they start laying people off. And this is where now the government and the Fed will try to fight this, because the government will try to help give people more money, whether it's in the form of stimulus, whether it's in the form of something else. But again, the government doesn't have any money to do this. So what do? Well, they're going to go to the Federal Reserve Bank and they're going to say, hey, Fed, the economy's hurting. We have to do something to help the people, to help the companies, because we need people to survive. And again, the government is running a deficit. They don't have big cash piles anywhere. And the Federal Reserve Bank, while it's called the Federal Reserve Bank, they don't have any reserves. So now the Fed is going to go out and print money out of thin air. they're going to create this money, they're going to give it to the government, and now the government has this new injection of trillions of dollars, and then they will just throw it into the economy. They have just created this new money. Now people have money, businesses have money, they can continue to operate, and then this also will start boosting the credit because now people have jobs again, and you have an income again. Now banks will look at you and say, ooh, you're making more money, you are more credit worthy, we are willing to lend you more money, and then this boosts spending, and this helps grow the economy. So that's, in theory, the goal that the government and the Fed try to do. The Fed also has one more superpower because they also have the ability to control interest rates, which also affects this. Because when we are in an economic slowdown, the Fed will try to cut interest rates to stimulate spending because that makes borrowing this credit even cheaper. You have to have some money in order to qualify for credit, but the Fed can lower interest rates to make it more attractive for people to take out this credit. If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to invest your money in real estate, our team put together an amazing guide on real estate investing. This guide goes over what real estate investing is, how to start using real estate to generate cash flow, and how to build wealth with real estate. This guide is completely free when you sign up for our daily newsletter. So if you want to read our guide on how to start investing your money in real estate, you can download that guide just by clicking that button right over there. Thank you for watching, and as always, keep hustling.